Hi, and welcome to Best in Tesla, a little Tesla short, where we're going to talk a little bit about the earnings call because that's today, Tesla's earnings call, Q1. We know the delivery numbers, but not the gross margins. And that is what everybody is talking about and focusing on. Can they get above 20% gross margin? I will show you some of the drivers to. Yes, they probably can. And I'll also talk a little bit about operating margins, because that was Tesla also said at the investor day. This is what they're really going to focus on and try to get the cost of their operation to come down, even though they scale up. So this is just all going to be very, very impressive. And I think people are going to be surprised, especially someone like Gordon Johnson that thinks that this is your revenue, this is your profit. So if you cut this price, you're going to have this much less in profits. He is not taking into account that the cost of operation has also come down. You can't take just one side of the equation. You have to calculate both sides in, or it doesn't make any sense. So let's take a look at some of these drivers, because one of it is, of course, the cost of good has come down. Elon has been talking about this for the last 2 or 3 quarters, that the cost of good has been coming down. So they're coming down to normal levels. So that's great. And we see lithium have dropped 60% in cost just this year. That is not going to be anything for Tesla this quarter, but that's going to come benefits through the next couple of quarters. So then there's, of course, the production cost itself to produce the car has also come down, also because of the goods have come down, of course, but also because of the economy of scale, where we have the Berlin factory and the Texas factory. They were both burning money last year, most of last year. By the end of Q4, I would expect they were starting to earn a bit of money, but they need to get to volume production, as Elon and Tesla calls it, when they hit that 5,000 units per week. And the Berlin is above that, and the Texas factory is above 4,000. So they are both contributing to the profit this year on this quarter so far, I believe, instead of burning money from Tesla. So that's already good signs. And then there is also transportation costs. It's going to be a big one for Tesla, as they now have a full year here with these two factories producing cars. But the Berlin one is on a whole new continent for Tesla. So just that fact alone is going to save Tesla a lot of time and money. If we take my country, for example, because I have talked with people at Tesla that have told me this, that from the car rolled off the production line in Shanghai, it took 2 months until it was at the delivery center in Aarhus, my city here in Denmark, where from Berlin, it takes about 12 hours. 2 months, 12 hours. That's a lot of time, and a lot of money, and a lot of emission saved by Tesla here. And there's also the mix of the cars that's going to have a big effect, because even though the Model S and X is still a lot of them in transit, so they're not going to be contributing so much here in Q1 to get the margins up, because they are high margin vehicles. But the Model Y is selling much more than the Model 3. And in last year, it was 40% of the sales between the Model Y and the Model 3 was the Model Y. It was 40% more in unit sales compared to the Model 3. But we don't know the mix yet this year, but we have an idea, as 70%, almost like 69% of Model 3 and Y sales in China, or the wholesales there, was the Model Y. And here in Europe, it is outselling the Model 3 5-1. So this is going to have a huge impact on the margins, because the Model Y is cheaper for Tesla to produce. So the cost there is less, but the sticker price is higher. And this is getting more and more Model Ys in production. So that is pretty cool. And then there's just the whole innovation. Tesla makes innovation every single day, every single week, all year round. So a whole year of innovation in the cars, in the production line, and so on, will have a big benefits on the cost this quarter compared to Q1 of last year. So that's going to be a cost driver as well. And then we have full self-driving, because we have the beta that come out to wide release in the US, and I think this is going to be a big contribution to rising Tesla's margin, because we're talking about $15,000 in almost pure profit if people buy this. This is more profits than what Tesla earns on their car themselves. And we are talking also people that bought the car maybe 1, 2, 3, 4, 5 years ago can suddenly go in and buy this $15,000 software because now they have this beta software available that is driving people everywhere and it looks amazing. So if I had the chance to buy this software, I would in a heartbeat. I would spend $15,000. I have already done that on my Model 3, so I'm just waiting for it to come here. But if I haven't, and I was able to get the full self-driving beta software that is driving right now, I would definitely do it. So maybe from all the many years of all the Tesla customers and the Q1 customers, the take rate is probably higher now. So if that is 100,000 people that have bought the full self-driving beta in Q1, we're talking $1.5 billion in almost pure profits that goes into raising up the margins of their vehicles. So that is a big contribution. But we'll see how many have bought that and how much that reflect in the margins. And then there is also, of course, all of this combined, but including Wright's law. I made a whole video about that. For every cumulative doubling in production, cost falls by a constant percentage. And we did see Tesla hit a cumulative doubling here in 2023. It's of course not on the same day they hit the cumulative doubling. The price drops by 15%. But they did hit a cumulative doubling this year compared to 2021. So we should see a big drop in that price. As Tesla also showed on Investor Day, 30% drop in the cost of making the Model 3 from 2018, I believe it was, until 2022. So in 4 years, it dropped 30%. Plays very well with the Wright's law because they had 2 cumulative doublings through that time. So that should also help the cost of production. So this is all things that are working against the price cut, making sure the price cut does not have a big as an effect as many people think. But then there is, of course, the operating margins, where I think this is the most important thing because this is what it costs Tesla to operate this growth story we are seeing right now. And even though we have seen the average selling price going down for the last 6 years, the operating margins have gone up for the past year. And in last quarter, it was above 16%, and I think we could see something like 18% this quarter. So if that's the case, then that's should be an eye-opener for people that even though they cut prices, the operating margin is still rising, as it has done through the years. But it was also make, an eye-opener for people that say that Tesla is only a car company, because the energy business side of Tesla should really start to shine here in Q1. I think this is going to be the quarter where Tesla becomes something else than just a car company, even for many of the automotive analysts, because they have to take it into calculation now because it's starting to become quite the margin. Because if we know the Lathrop factory is producing about 12 megapacks a day, and Nevada is also producing. So an average of 12 a day here in Q1 is probably not unreasonable. And that is $2 million a piece. So that is $2.2 billion in this quarter with 92 days. And then we also have Powerwalls. If that is still 6,500 Powerwalls they are spitting out every week, that could be a $500 million in revenue as well. So that could be $2.7 billion in revenue. And this is a high margin revenue. Maybe something as high as 40%. We still don't know. But if that's the case, we could see maybe something like $1 billion in profits from this business. And last quarter, Tesla had $5.5 or $5.7 billion in automotive profits. So this is like adding 20% or something like that to their profits. This is quite a big deal. And it's the growth here is insane, especially if we compare to 1 year ago, because then their revenue in their energy and storage business has grew something like 450%. It even grew over 100% from last quarter, if this is the case, and they will deploy something like 4 gigawatt hours of energy. That is as much energy as Tesla deployed in all of 2021. Last year, they deployed 6.5 gigawatt hours. So this is quite a big amount if they get close or nearby 4 gigawatt hours of deployment. So I think this is going to be the quarter where we see the energy side of the business is really starting to take off. And it's going to be so big that the automotive analysts can't ignore it anymore and just say this is never going to happen. It is happening right now, and it's only going to grow through this year with Lathrop and then next year with the China factory as well. So I think they can't ignore it anymore. I think this is going to be the quarter where we see operating margin rise. We see their storage and energy business rise as well, and they have to take that into calculation. So I think we are in for a good showcase, but we'll see if the margin on their automotive business is over 20%, or if it's under, or the stock goes down and we get a discount on the stock. Oh, what will happen? We'll see. We will know a lot more here tonight. So I'm not going to be up filming it. I'm going to make a video afterwards on all the things. So stay tuned for that. And thank you so much for watching this little Tesla short. And until next time, take care out there and be nice.